And my thought was an idea about a trade on Meta platforms. META is the symbol for that. And where I wanted to go with it was a clearly a long trade idea, because I looked at the chart, I looked at the opportunity there, how the stock had done prior with in front at post earnings on a couple of last 3 to 5 quarters, and it's other than being a nice opportunity long. Further, the stock had fallen sharply. And you can see it on the chart over there. The stock had fallen sharply from the all-time highs just a couple months ago, from 735 all the way down to about 480. Huge drop, 30%. But now is making a comeback, and it got above that downtrend line there. And I was looking for that 630 level, and you can see, you could have seen there back, that was an interim high in March. And I targeted that level when I was talking about this with Market Navigator, with Don Chu, but I also saw that on the chart, and I saw an opportunity where the stock was trading at about 548 before the day before earnings came out. So my trade idea here was, well, let's take a little bit of moderate risk here, take something out of the money. And so I went with the 560 call, talked about that one. But that was expensive. That was about 26 bucks, $28. It says $28 on, it'll say 28 on the screen here, 26 on the screen, but it was actually about 20, almost 28, and then it came back to about 25. It was about $26. Still a little bit too much for me to pay. So I wanted to ease off on some of that, lay off some of that risk. Sold the 600 call. Why the 600 call? Because that was about $52 above where the current price was, and the expected move post earnings was 48. So if the stock just did a little bit less than the expected move, I could capture a lot of that premium from a call out of the money, far out of the money. $600 was about $52 out of the money. And if we could, just for 2 days, actually, because the earnings came out Wednesday, I only needed 2 days worth of premium to worry about an expiration. And that's the end of that. So, what transpired there was looking at the 560 call against the 600 call. So I'm going to go long the 560, short the for May 16th, short the 600 call, which expired May 2nd, for a net of about $21. So I've effectively cut my risk by about 25%. What's the downside? If the stock tanks, I'm losing all that premium, but I'm only going to lose 21 versus 26 if I had just gone along with a straight, a straight call. As it turns out, this was just a phenomenal trade result, because ideally we would have wanted to see the stock finish Friday, May 2nd, right at or near 600. It finished at 597. Absolutely perfect, because the 600 call, which I sold for $5, disintegrated, went to zero. Meanwhile, I'm long the 560 call still, but that price is ballooned. Which I bought it at say $26. It's now worth 46, because I've got 2 weeks of time left to go on the option. Now we're from this recording, we're about a week and a half away. Still have with 2 weeks left to go. I'm deep in the money with this call option that I'm long, and I have other options that I could do. I could sell a call. I could just leave it alone. In this case, what I did is I've left it alone, and we'll see what happens in the next couple of weeks. I do have a mental stop in place that if the stock closes below 590, I'm out.